All right, here we go. Welcome back for another month of the Investment Committee webinar. Appreciate you guys joining us today in our April edition. There's certainly no shortage of things to talk about in terms of what's been happening in markets. So we have a few things for you today. I want to give you a market update, look at the numbers, also take a look at some recent news stories that we've seen. Obviously, the Iran conflict has been top of everyone's social media and news. So we want to touch on that, along with some other themes that we've been seeing in the markets. And we also have some interesting charts and graphs to take a look at today. So taking a look at the market vitals so far in 2026, I think you can tell it's been a roller coaster just by the fact that a lot of these numbers from the close of yesterday already seem stale, just given what's happened today. So the most recent news, there was negotiations around a ceasefire last night between the U.S. and Iran, and the market had a very nice rebound today as a result of that. So we can see what's happened over the last month, but that's been punctuated by today's jump in equity valuations in the market because of that ceasefire that was announced. So taking a look at some of these numbers, S&P as of yesterday's close was down about 3%. It's now down about 0.5%, so 2.5% jump there. But if we look at the themes, it's still similar to what we've been seeing previously. So the Russell 2000 index, which is small caps, and the Vanguard Total International Stock Index, both leading the way, up 3% apiece, while some of those more US based indexes like the S&P 500 and the NASDAQ were negative as of yesterday's close. What are we seeing, Brandon, in terms of some of the specific sectors in the market so far in 2026?
Yeah, so right now, kind of as you mentioned with the Iran conflict, we're seeing energy, year to date up 35%. Whereas if you're looking at the other sectors, if you're looking at technology and communication services, both are down year to date. But even if you look at the past month, we updated these as of the close yesterday, like Sean said, and looking at technology where it was down in the past month, after yesterday, it's actually just slightly positive. But I also think it's important if you take a step back and look at this, like these are really only 3 month performance numbers. Where if you look at the past year or 3 years, you're still seeing what we've been talking about in these webinars is where technology, if you look over the past year, XLK, the sector is up 50%, and over the past 3 years, 88%. And even if you go back to the major indices, like Sean was mentioning, if you look at Nasdaq and SPY or S&P are both up 30% in the past year and over 60% in the past 3 years. So just always good to take a step back, and while we want to talk about what's going on currently, but also realizing how everything has been doing over the long term too.
Yep, absolutely. And the number that really jumps off the page, as you mentioned, Brandon, is that energy sector up 35%. So oil has been a big topic of discussion over the last month with the Iran and US conflict. The Strait of Hormuz, which Iran kind of oversees, supplies 20% of the world's oil. And so there's been a big supply shortage over the last month as Iran has shut down that strait, which has resulted in those oil prices really skyrocketing. And so that's moved a lot over the last month as new information comes out. Now with the ceasefire, oil fell today, so it has been a roller coaster watching that. But it doesn't seem like this is something that's going to disappear tomorrow. I think there's going to be a lasting impact on the energy sector and on the price of oil. And that's the thing that really jumps off the page looking at that sector performance so far in 2026.
I think one thing to correct a little bit there, Sean, is Iran does not oversee the Strait of Hormuz. They just neighbor it.
Fair,
Oman neighbors it too. It's they are just exerting their force upon it.
fair.
Um, but it's technically international waters.
True. Very true. Taking a look at what's happening with the Federal Reserve and some of the data points that they are looking at as they carry out their job. Looking at inflation, the most recent inflation report came in at 2.4%. We saw over the last couple of years that was really sticky around that 3% mark. So that is trending downward, which has helped with some of these basis point cuts that we've seen in 2025. Additionally, unemployment over the last 6 months has been between 4.3 and 4.5%, which is a little bit higher than it was over the last couple of years. So there's those two factors that the Fed is looking at in terms of is the economy slowing down a little bit? And then you throw this new wrench in there of oil prices being a lot higher. And how is that going to impact inflation moving forward and economic data as you look a year into the future from today? So they're really juggling, okay, what does economic data look like today in terms of CPI, unemployment, but also what does this new conflict in the Middle East look like in terms of oil prices and how that affects economic data looking forward. And so right now, the expectation is no rate cut in 2026.
Yeah, and I think we've been mentioning the Fed Watch tool in all of our webinars this year, and starting out we mentioned there might be some rate cuts, and they've slowly dwindled back. But after with oil spiking recently, that's really when we've seen kind of a decisive watch tool estimate of saying, hey, there's not going to be any rate cuts this year. Where before we were still seeing some consensus that there might be, whether it's just one. But now when you look at it, if you go out all the way to the end of the year, it's really not saying any.
Yeah, I was just looking out at June of next year, and June of next year right now is at $71. It was at $62 before the strike in Iran. So even a year and change from now, it still has a $10 elevated prices.
Yeah, that's for oil.
Yeah, those are the futures contracts on the NYMEX for crude.
Got it. Yeah.
It's wild looking at so just for those listening. So futures trade on a monthly expiration basis for the most part. There's a little bit of spot check on that comment. But for any oil, you're going to look at a spot month on when it settles. And so you can look across all the months. So right now you have the most recent month, it spiked all the way up to 117 and then, come back down. But if you went out a couple months, it was kind of just hovering in the 80s and had never made that huge spike. So you're seeing real supply concerns now that the market doesn't feel like it's going to come later if you look at that futures curve. That futures curve is also how we predict what the market thinks the Fed is going to do with respect to rate cuts. So the futures curve kind of tells you, if you look at it, tells you what the market thinks is going to happen based on all the information it's digesting now, and you can kind of pick away at the tea leaves. So if you're reading the market now, what it's saying is in a year that there's still going to be some impact to the price of oil based on this conflict. As it stands right now, it's going to be not as dramatic though, or about half as dramatic as it will be at the end of the year. And if we look over the summer, it's going to be a little bit more dramatic during that period. So, the futures curve tells you what the market is thinking, and it does it for predicting Fed cut rates. It does it for, any kind of range of scenarios that we're trying to get a gauge on what's everyone else thinking. The futures market is a pretty good place to get that information. And so when we're talking about that, it's basically how traders bet on an outcome versus time.
All right, great. For recent headlines and kind of news stories, we wanted to cover a couple of topics here. First one is AI and technology shifts. Google recently came out with this new turbo quant algorithm that is significantly reducing the memory required to run AI models. So the market saw a little bit of a shift here in semiconductor companies like Micron and Samsung feeling a little bit of pressure. Investors are kind of reassessing hardware demand, with this new turbo quant algorithm. And then Meta, on March 27th, Meta had a bad day, 8% decline. The company lost about $119 billion in market value in one day, following some legal troubles So Meta was found negligent for designing features that intentionally fuel addictive behavior in young users. And this was really important because legal risks here, they shifted from like content based to actually being the platform design. So this is opening the door for potential 2,400 similar suits that they were previously trying to be in the clear from, saying it was content. But now with this new suit that came out, it turns out that it's the platform design. So that's what led to that March 27th day. Brandon, I think you wanted to share some stuff on social media here in general.
Yeah, just more of a general something I've been seeing is like ads or commercials for Instagram that they're making a teen version. So as these social medias have kind of faced these headwinds, how are they adapting for you know each generation of what are the different use cases and how can they kind of combat the oh this is addictive and everyone wants to use it, but how can they tailor it towards each generation, especially for the younger generation when parents want them to be monitored in kind of a safer place versus what anyone else might be able to see on here.
I feel like this is a little like processed foods and like foodstuffs that Americans put in their food, but like, there were a number of other countries that were way ahead of this. Australia was pretty early in, saying like, hey, 15 and under can't use social media because of the addictive properties. A number of countries in Europe have had policies on this. In America, I feel like I don't know if we made social media, but I definitely feel like, we're one of the exporters of social media. And it seems like we've just been way behind on just accepting the reality around this. So this didn't come as a shock to me. The
Yeah,
one
and
thing
it
I
seems
want
like
to
something the parents really care about, right? Is not having their children addicted to social media. When's the right age to get them a phone? So it's interesting to start to see that ideology like trickling into the stock market and how stocks are actually trading. I thought a cool story just based on that because it's clear that it's important to account for the addictive features of social media, and it's something that a lot of people care about. So.
Yeah, and I've always thought Meta's had some legal exposure here because, there's been a lot of kind of quiet talk about, internal documents that mention these kinds of things. And, the Justice Department has had these things for a while, and this was a little bit expected. I can tell you that in my household, we have no plan of giving our young teenage children a phone anytime soon, because we've read a lot of these reports on what they do. I do want to just talk about the turbo quant for a minute, and I know that's going to lead into, I think, Brandon, you're going to talk about the macro tailwinds and growth. Um, this is very similar to what happened last year with DeepSeek. If you guys remember, there was a report out of China that a hedge fund owner had created an app. It was one of the most popularly downloaded apps called DeepSeek, and he claimed to have produced computing power with effectively an AI that cost about $6 million to put together. Now, whether or not the numbers are right or wrong, it did creatively use large language models in a much more efficient way, so there was less power consumption and less need for computing power to accomplish, I'll call it simple queries. Um, there's going to continue to be announcements like this. There's going to be innovation in this space. There's going to be easier ways to do things. Despite DeepSeek, we still see a $600 billion commitment from large tech companies this year on data infrastructure, Google being one of them. With this kind of, projects, it's not like Turbo Quant was happening in some, custodial closet somewhere and management just found out about it last week. This is something that they've been working on creating more efficient ways to enhance output for AI queries. They have been trying to repurpose and reuse existing hardware that they have to see what additional benefit they have. They actually changed their depreciation cycle on a lot of old hardware that they have just based on the fact that they feel like they can repurpose it. So this is, this is going to continue to happen. There's no aha, oh my God, this is the turning point moment here. It's just a matter of this is going to evolve the same way that a lot of technologies evolve, which is it's going to have leaps and bounds and steps and moments which are going to be more memorable than others. But the focus and effort around making a more efficient AI technology is going to be there, and it's going to have some pros and cons there. We're using a little less energy to get the same output. Does that mean we're going to use it less? Does that mean it incentivizes us to use it more and for more features? And at the same time, if we are able to make it more efficient, better uses, not consuming as much, does that lead to eventually higher productivity? And I think that's kind of the segue I want to leave for the macro tailwinds.
Yeah, so for the macro tailwinds, I think something interesting that Jerome Powell said at Harvard last week was, the national debt surpasses 39 trillion, which is a huge number. But what he focused on was not the actual 39 trillion, but the actual path, and how the economy is growing, and how eventually, in the other stories we can talk about it too, is how AI contributes to that GDP growth, and how big of a factor that is in order for that, for the economy to end up growing faster than ultimately what the debt is growing. Um, and obviously AI contributing to real economic growth. Economists are now actually able to measure that. It's not just hey, how are you using it at work? There's more real numbers around it. And the St. Louis Fed reported that AI related investments contributed about a 1 percentage point of real GDP growth in the first 3 quarters of 2025. And I think you can see that in the corporate performance numbers too. We've talked about this specifically with Microsoft and some other companies in previous webinars. But looking at the S&P, the net profit margins are 13.2%, and if those expectations are hit, this would be the sixth consecutive quarter where you have those double-digit profit margins, and even expected revenue was increased to 9.7% from 8.2% just from the start of the year. So you can kind of see how, from a corporate perspective, of how these companies are still improving and still growing. And AI is an impact, and as we get more data, it will be interesting to see of how much of AI is actually percentage of that.
Yeah.
Yeah. And just to give some, sorry, Jordan, go
Go ahead,
ahead.
Trevor. No, no, go ahead. Go ahead.
I was saying, just to give some context around like the 39 trillion, the US isn't projected to hit 40 trillion annual GDP until 2032. So as Brandon says, I think looking at how GDP is growing versus that national debt number is more telling than just saying, oh, 39 trillion, that's a ton. If we're able to grow our GDP at a certain rate to where that surpasses the debt, it becomes a little bit more serviceable. If we're just looking at interest payments made on that debt, in 2025, there was 1.1 trillion of interest payments made on the debt that year. So if debt continues to grow and starts to really outpace GDP growth on an annual basis, that number becomes scarier and scarier. And that path, as Jerome Powell said, is not sustainable. So
Yeah.
hopefully AI can help that GDP growth continue to skyrocket. And that's something that we're going to touch a little bit on in the next slide.
Yeah, one other, just to put into context, because sometimes people talk about the debt to GDP ratio. So 39 trillion, we're currently at about 30 trillion. Debt to GDP ratio is about 133% right now. When it was getting to 100%, people started to freak out. If you look at a country like Japan, which has the highest debt to GDP ratio of a developed country, it's about 250%. So you can go beyond this level, but it just gets harder and harder to kind of, walk it back. I think for anyone who's ever been in a little bit of credit card debt or a lot of credit card debt, it's pretty hard to fight those interest rates when they start becoming major, major dollar amounts on your statement. And as Sean said, at 1.5 trillion, when does it become one of those bone crushing interest payments like when you take on major credit card debt and you got to go, call one of those companies that still advertise on the radio to consolidate your credit card debt and things like that. So, it's something that I think we need to keep an eye on. I'm glad Jerome on that Harvard presentation or Harvard discussion, I'll call it, brought that issue up. And I'm also glad that he put that positive spin that if we're able to get productivity and put money in the right places, that, I don't want to say we're going to get our way out. We'll always have debt, but can we get it to grow at a rate, GDP to grow at a rate where it potentially outpaces that debt growth? And that we have not been great at in this country.
Yeah, it's a great point, Sean and Jordan. And with this slide, we're kind of looking at similar topic with AI productivity and its economic impact. If you look at the chart on the right, you could see that almost full percentage point of GDP that AI investment contributed to in the first 3 quarters of 2025. And the idea here is, with the landscape of AI continuing to expand capabilities, not just replacing jobs, but a Harvard Business Review report came out that employees are using AI to take on responsibilities that previously required like external support or help. So productivity is increasing here. And then there was also this research report from the Wharton School suggesting that generative AI will increase GDP by about 1.5% by 2035 and nearly 3% by 2055. Um, so this is kind of a visual of the idea of like the productivity J curve and with AI, contributing positively to the economy and GDP growth. Um, kind of just to put things in perspective as we talk about national debt and economic growth.
Yeah, and if you measure real GDP growth, it's technically population growth times productivity growth. And that's GDP growth in real terms. Nominal terms, you add inflation to that. So productivity, GDP growth is expected to be somewhere between, I would say 100% of the estimates are going to be between 1.5 and 4% over the next, 20 years is going to be the range you're going to look at. So the fact that there's the expectation that AI could contribute as much as 100% to just under half a percent of what overall growth is expected to be kind of tells you a lot there of how impactful this technology could be if these expectations are right. And I would argue that the real optimist about how quickly AI is going to advance and be able to evolve and help in different industries would tell you these predictions might even be small.
Yeah.
And maybe the we would recognize the benefits shorter is a better way to say it.
Yeah. And it's so interesting. Just looking at the last month, it's so easy to focus in on geopolitical conflict, what's happening in the news every day, but really zooming out and taking a look at what's happening in the market from a grander scale of this AI super cycle. We're in such a unique time, I think. Um, there's so many different lenses to look at the market. You can look in the 1 month period of what's happened in the last month in terms of this conflict that's going on, and then you can zoom out and really take in the optimism that we're seeing, the strong corporate earnings, the profits, the artificial intelligence innovations that are happening. So I think it's important to look at the market in both lenses and not just focus solely on what's happening in the last month and not just solely focusing on artificial intelligence because there are optimizations that you can make in your portfolio given what's happening on the more near term as well.
Well, one of the things here I think that I hear a lot about is there's some concern that people get. They start to say, whether if you're in the working world, you say, well, what's my job going to look like in 5 or 10 years? And then there's the other aspect. If you have kids who are working and you say, is my kid, going to even be working? People with kids my age are like, is it even worth sending my kids to college anymore? Because is everything that they're going to learn pretty much going to be replaced? And I think that those are all very reasonable questions to ask. This technology is probably going to be disruptive. and it will leave people behind if they are not aware and thinking about it and kind of doing the math on what the skill sets that you need for different roles that you're targeting and which ones AI can do easily and which parts of those skill sets AI is going to have more trouble doing. Um, and that's something I think that everyone should be kind of that's something to think about if you're investing. That's something to think about if you're investing your time and energy in an education. That's something to think about if you're investing in the future of your career and everything else. These are not bad things to ponder as we look forward and think about what might be. And you know who's actually a great person to do this little experiment and think about what that future can look like? AI. So it's a very interesting feedback loop with this new technology. Um, and it will be interesting to see how it goes. But I think that with some of the scary comes a little bit of optimism. We've got a lot of optimism on the page right now, but there is also going to be some disruption here. There are going to be industries and businesses that have a lot of problems. We have a very low payrolls number right now. Some people think it's artificial intelligence whitewashing, where companies are firing people, claiming AI is doing their job, but they're just using it as an excuse to get rid of people. Um, Probably a little bit of both is what we're seeing with the weak jobs number. We got a better payrolls number recently, but we'll see if that's short-lived. Um, these are things which are going to be disruptive through that entire period, and that creates some opportunity. We've talked a lot about the SaaS apocalypse that we've been seeing, where a lot of the software as a service companies are getting hurt because of the fear around AI. We've also talked in previous calls where we think some of that's a little overdone, that this might actually not be as horrible for SaaS companies as some market participants think. But there's a lot of changes happening, and this does create some opportunities. And I think being educated on these things, I think there's a lot of people who want to have the emotional conversation or the Terminator 2 conversation around AI. And that's interesting on a Saturday night, when you've got nothing else productive or constructive to talk about. But I think if you're actually sitting down and want to, think about productively, what does this technology mean to me? I would sit down and kind of write out the questions you have and then start to engage in some Google searches or listen to some talks or things like that because it is a really interesting space and it's changing very quickly. The amount of content that you can consume on this topic and go down a rabbit hole. Try not to go down the emotional rabbit hole, but the intellectually curious rabbit hole. It gets incredibly interesting very quickly, and there's a lot of science fiction outcomes which may be closer to reality as a result of this technology in the next, 10 years or so. It really is. I've heard some incredible and crazy things in my own search. So, we also welcome hearing what other people are seeing. Like we say, there's so much information going on out there. It's just incredible.
Yeah, Jordan, I think to your point about the talk about AI coming for jobs, it's interesting to think about like Jeff Bezos is a good example. Amazon employs over 1 million people, and I think that it's a good example of what was going on with the early 2000 dot-com boom. Think about the next CEO of a Mag 7 size company as a result of AI is probably a high school student today, and all of the jobs that these companies can, employ in the future and add to the workforce.
Yeah, it's a good point. It's I mean, look, I don't obviously, all of us and on this screen are very familiar and fluent in using AI, and similar to the internet. You guys never had AOL dial-up where you had to actually wait for the phone line to be open to get online. There will be a point in time where people are like, "How did anyone live without this?" And we'll see where that goes, but uh, it this kind of concept triggers both excitement and fear, and that's totally human. That, we should both kind of have a little bit of excitement, but a little bit of scared. It should feel like a roller coaster ride, and it likely will be, especially for some sectors, especially for some investments. It's already been a bit of a roller coaster ride. And, people don't want to miss it, but people don't want to get caught holding the bag. And we saw the same thing with the internet. People gave up on it. They kind of dropped it, and it creates a lot of opportunity, as we've talked about, some of the stocks which we feel like have been left behind. um, we've seen some stocks that are down 30% this year, even though the market is, as you said earlier, Sean, almost unchanged
Yep.
on the year, even on the Nasdaq. You've got major market component companies like Microsoft down 30%-ish. And you normally don't see that much disconnect between a company like Microsoft and the overall market's performance. So, and again, Microsoft, it's in the service sector. It's got OpenAI investments, and Copilot has kind of been a little bit of a dud. But it seems a little not connected to the fundamentals, how much that stock's been hurt. But again, people are investing very thematically. They're kind of, shooting first and asking questions later, whether they're buying something or selling something, because the impact of one storyline, and we've become such a Twitter following investment culture that I think people are missing some of the math. So if you do a little extra legwork and you think it through, there's opportunities that happen. We saw that with Google in the past couple of years. Google was missed by the markets like significantly, and then suddenly people woke up one day and said, "Oh wait, they have a SpaceX investment. Oh wait, Gemini's actually pretty good." It was almost like a as if the market was just completely asleep on it because they were too busy focused on OpenAI and then Claude, and it's like it's very very manic, but that creates opportunity.
Absolutely. We were talking earlier about Nike. 10 years ago, I was in college at my wealth management association meeting, and one of the participants did a stock pick presentation on Nike. And I remember clearly the stock price of Nike 10 years ago was in the 60s. And you look today, it's in the 40s. So just thinking that in a 10-year span, Nike, one of the biggest shoe companies in the world, household brand that everyone's heard of and everyone's probably worn Nikes, to think that in that span, Nike has actually lost value in terms of its stock price is kind of insane to think about.
It is crazy.
It's
Anytime you
nuts.
think a decade later, you figure something should be higher. But that also shows that, it's not always that easy. And there was a point where Nike was a lot higher
Yep.
after COVID. And then, they just they kind of made a couple errors in trying to go fully online, and they made some mistakes. They've lost shelf space, and they're having trouble getting their brand back. But
Yeah.
it's trading at such a low multiple at this point, it's almost jaw-dropping.
Yeah, there just seems like there's a lot of competition also in that space with shoes, apparel. You look at companies like Nike and Lululemon and spaces that they used to dominate 3 years ago. They're now competing with OnCloud and Hoka, and even Amazon has cheap alternatives to a lot of this athleisure or the shoes just through Amazon. So it's hard to maintain dominance in a marketplace that is so competitive when there's new companies popping up left and right and a lot of competition in the space.
Direct to consumer selling on social media, we went full circle.
It's true.
All right, do we have anything else we want to touch on today, guys? Or I know a lot of people probably were hoping that we were gonna uh expound about the Iranian conflict, but that's changing at such a quick rate. And additionally, it does not we feel that everyone's probably having their fill on that news aspect. So we want to make sure that we focused on some of the things that are not on page one of the newspaper, but you got to go to page three, four, and five. But those things are a little bit more long-term impactful and are going to play a much bigger part, we think, over the next, 3 to 5 year landscape. Whereas, yeah, oil prices might be elevated, and maybe this conflict gets drawn a little bit out, but similar to the Russia-Ukraine conflict, That's not headline news anymore, and that's not really driving prices or market performance the same way that at the start when it's got all of our attention. So I'd expect the attention around that conflict to wane over time, regardless of how long it ends up lasting or not lasting. And these are going to be the things that, are going to continue to be important and are going to continue to drive how markets perform over the long term. And that's why we chose to focus on that and not get caught up in the political fray and whatever else is happening, out there that is taking up 90% of the news time.
Yep, well said. We appreciate everyone joining this month for the investment committee webinar. We'll be back next month with some more exciting news stories and updates for you guys. And appreciate you joining today. Thanks, everyone.
Thanks, guys.